And as always, when we pivot to the EIA data, we always like to look at, where is the 4-week rolling average, and there you can see that the 4-week rolling average is right about 14.5, and you're starting to see them kind of cross over. And this is what we've been saying, is we're just going to be below where we were in 2021. And a huge percentage of that is driven by the massive slowdown in trucking and just activity on the distillate side. So gasoline is again, slightly below where it was in 2019, 2018, but it's the distillate side that is going to be the difference between where we are today and where we were last year. And that's why we continue to say that about 14.5, 14.3 to 14.5 is going to be where we live at this point. And we're going to have your seasonal fluctuations. Like you're going to have a big pickup in Thanksgiving and Christmas. But on the aggregate, you're going to see a bit more pain, especially as the consumer really starts to take that pain, which we talked about in the Econ show yesterday, and we continue to see as a bigger pressure point. And one of the leading indicators on the trucking side, you can see that non-farm payrolls in terms of truck transportation has actually gone negative. It's been the first time since 2020. We had that one little blip in the beginning of the year, but it's really been a steady increase. And now we're starting to see that slowdown. And we're going to talk more about demand as we did on the Econ show segment 1. We talked about trucking, and we're going to talk about it again in this segment. So then when you look at distillate, even as you have trucking slowing down and in most cases actually below 2019 levels, which we talked about in segment in the Econ show yesterday, you're having trucking now that is slower than. And to be clear, we got bearish in the end of 2019 because of trucking, because of what we were seeing. So it's even below where we were already getting bearish. So to get you an idea of how we're viewing the economy, the health of the economy going forward. But even in that backdrop, distillate still had a draw of 4.85 million barrels, bringing us 33.1 million below the 5-year. And obviously, a huge chunk of that is driven by Pad 1 with a drop of 20.8 versus the 5-year. But now you have to look at Pad 2 and Pad 3, especially Pad 2, with the issues on the refining side, because they're coming into the lowest they've ever been. They are at the lowest they've ever been on the 29-year average when looking at distillate storage. So distillate had a draw of 1.66 million in Pad 2, which is 5.7 million below the 5-year. We expect that to continue to get worse and put even more pressure. And now Pad 3 has the option of, well, we can go abroad, we can go into Colonial, and then we can try to go up north in terms of rail, and the economics might start to make sense to send more by rail. But as they try to take more of that international capacity away, that should free up for additional imports into the U.S., which is why we should see a creep higher in distillate imports into the East Coast or Pad 1. But then when you look at the aggregate, looking at the U.S., obviously distillate is at the lowest it has ever been for this time of year. When you look at Pad 1, again, lowest by this time last year by about almost 10 million barrels. So again, you're seeing a massive issue right now that is not fixing itself. And this is in shoulder season when you look at the other years, we should be building. And instead, we're either drawing or just going sideways, which is going to put us in a very difficult position. And if you believe the Farmer's Almanac and some of the long-dated weather forecasts, we're going to have a cold and snowy winter, which, again, is going to put us at even more of a problem. Now, when you look at Pad 3, it's following 2021 levels. And again, the optionality is there. They're going to pull in more heavy sulfur fuel oil, try to make as much distillate as they can to push into the market, have that back and forth. But they're going to have optionality, and they're going to be able to capture a fairly healthy premium, as are other refiners in Pad 2 when you're looking at who is operating, and which is one of the reasons why we do like CVI or CVR Energy as an option to kind of express that when you're looking at the Pad 2 level. Just giving you an idea of who has a high distillate cut and is in an area that should really benefit from the drawdown of cheap Canadian crude and the shortage of distillate in the market. Then when you look at disti product supplied, we're coming to the top of the cloud. And as we progress into heating season, we are going to move much closer to the 5-year average and not below it. It's just we have a little bit of a bump in trucking, which we think fades, and then we're going to have this move into the heating cycle. So when you look at trucking demand, a slight increase from that 51 to 55, really kind of holding it at these levels, but the leading indicators are showing much worse worse economics, which is going to pull some of this down, especially when you look at what is coming into the U.S. in terms of LA and the West Coast from China. Where are some of the flows going? And that's where we continue to see more of a downward trend. Again, still downward trend versus historics, but when you look at some of them, the pressures remaining, especially against 2019, another supporting data point on why we think the consumer is really weakening as we're going into the winter, into the holiday season. Now, when you look at rail, just because there was some timing delay with getting the data, total car loads were down 2.8% versus 21. Petroleum and petroleum products are up 6.3%. That's what we've been guiding to. That's what we've been saying. That's going to continue. Grains is going to remain elevated as the Mississippi remains choked off in some points with limiting the amount of grains that can move through that system, as intermodal is going to continue to be a key component as again, companies can wait a little bit longer and not rely on trucking, making intermodal cheaper. But the reliance on this for farm products, grains, and now petroleum and petroleum products is going to make the potential strike a much bigger situation, because so far the unions have not ratified and don't agree with the current deal that has been put before them. That is still ongoing, but the grace period for when they can strike is coming up and is expiring, because once the union reps and the management come to an agreement, then that goes to the people that are on the ground. I think they have 30 to 45 days to ratify it. If they don't, they can either strike or go back to the drawing board. So again, there's a lot of things to watch in that segment. And then pulling that forward, when you look at import volumes, this is what we've been talking about in terms of the big drop in import volumes, how that continues to show up. And now we're coming below where we were in 2019. And again, if you remember or you were following us, we started to get a bit bearish on the U.S. economy in July, August of 19. And then the data sets continued to get worse. And we saw a big pivot in October, and that only accelerated into November and December. And we're seeing something very similar this time around as we did in 19, which is why we think there's a bigger problem on the supply, on the trade side, on the economic side, and more importantly on the consumer side, bringing this down. Now, when you look at temperatures, things are getting very cold for the Mid-Atlantic, the Northeast. Essentially from Nebraska over, from North Dakota down to Texas, you're seeing a big cold patch coming through, which is going to be supportive of natural gas consumption. It's also going to be massively supportive of an early start to the heating because I think today's the last day, at least in New York, for some heat, and then we're going to get into the mid 50s, which means in the overnight you're going to be in the high 40s, which you're going to hear that heating kick on, and that's going to be again a big supporter and driver of really where we're seeing and pulling that into the system. Now, when you look at gasoline stocks, here you had a build of 2 million barrels, 2.02 million barrels. There was a build across the board, 18.2 million below the 5-year, but that's going to adjust quickly. As we were describing over the last couple of weeks, the economics opened up a bit in terms of the ARB coming from Europe into the U.S., and that showed up here with an increase in imports of 219,000 barrels. Still below the 5-year, and the reason why we're going to stay below the 5-year, even as we have a massive, continued builds in the European markets, is the cost of shipping. The rates have gone up, and that's going to keep some of that ARB struggling, which is again going to trap some of that gasoline in the European markets. until it builds to such a point that the discounts will come through, enabling and covering the cost of shipping, which is going to be an important piece. So again, we do expect to see that gasoline trend higher as it is right now, right at that 29-year average, as we think it'll build, which again is very normal for this time as we start to see this flat line and then start to see that grind higher. So when you look at what is happening here with the gasoline total inventories, this just puts into perspective where we are versus previous years, just so you can kind of see it a little bit differently. Now, when you look at the congestion, China obviously had Golden Week, big drop off, kind of bouncing back to right around where we were. As we go into the Chinese Communist Congress, which starts this weekend, we cover some of the things to look at in the Econ show from yesterday in segment 5. That's something that we think would be worthwhile. But again, we do see that there is, essentially demand is going to hang out here for China. TomTom congestion index, when you look at North America, slowing down, Asia Pacific slowing down, Europe hanging in a little bit better, but we do see a little bit more of that roll. And it's not that it's anything major, it's just very seasonal, just given kids are back at school. You have the end to the Jewish holidays in some of the big driving areas. And now we're going to come into, I think, a more stable progress at this point. When you look at North America, like as we said, anywhere between 9-10% below normal versus the week on week about 5% below normal, and we think that holds. And this isn't going to help. And as we were saying, we expected diesel to go back above $5, and now we're at $5.18. Given the storage backdrop, given all the economics we're talking about, that is going to continue to be a massive hit and really hurt on the inflation side. Because remember, September, you had that down move and we had an increase in inflation. Now, when you look at October, we've had a huge about face. We've gone up a significant amount on both diesel and gasoline, which is going to provide more against tailwinds for those inflationary numbers, and again, put another cap on the consumption of it from the consumer's perspective. Blending components right at the norm for the last 10 years. We expect, as we said, this continue to grind higher, especially because the options for a lot of these blending components are either petchem or the gasoline pool. And with petrochemicals slowing down, we expect to see a lot of that end up in this pool as a means of an area just to put product at this juncture. Then when we look at gasoline demand, again, as we said in segment 1, last week we had a 10-year high. Now we have a 10-year low. It's somewhere in the middle. Hurricane Ian is a big kind of driver of where we sit and where we are right now. So Hurricane Ian pulled a lot of product into the market, and now we're seeing a lot of product come back out, and we'll get back into that normalcy, which is still going to be on the very low end when you look at where things sit at this point in time. And then when you look at as what is driving this, it remains work from home. It remains dual flexibility. When you look at the workplace, still 20% below what was normal. And that's why that 20% or 18 to 22%, take your pick, is going to become really that new normal here. Now, when you look at propane, propylene, build of 1.09 million, that brings us 600,000 above the 5-year. And when you look at that average, realistically, and this is looking at the last 6 years, you can see we're right there, but it's the slowdown in petchem that is resulting in this. We've had an increase in production, slowdown in petchem. Exports still remain very robust. That's still going to be the outlet. But again, that's where we should see this move along that seasonal norm and stick around that 5-year average. Jet fuel, there was a draw of 140,000 barrels. When you look at just demand, as we've been saying, right within our wheelhouse, we expect that to remain sideways. And then when you look at versus 2019 and 2020, just filling in the gap between 21 and 19, we're going to kind of fill in. And it's important to look at, things started to get weaker towards the end of the year. So the 2019 comps are actually going to get easier as we go into the end of the year, which should be good on a year-over-year basis, but it still doesn't show us getting back to where we should be, just that we're getting back to where, that low end of the scale on 2019. Passenger departures, flight schedules week ahead is 0.71% higher over the next 12 weeks than it was a week ago. And again, that's the plan for the holiday season. It's still a little bit low versus historics. So that's where we're going to continue to be at a bit of a low end, especially when you look at some of that where we are previously. So when you look at the numbers in general, we should be seeing additions. It's just the additions are coming much slower than they have in what what you want to call normal years. Now, when you look at open table, things are on a global level, 5 to 10% better. But as we've been saying, things have been fairly flat in the U.S. And as the consumer comes under pressure, people get forced back indoors because a lot of the outdoor seating has stuck. That'll, again, shrink some of these baselines. So that's what we have for you on the segment 2. In segment 3, we're going to go deeper into OPEC's new estimates, why that's important, and what to look at in terms of how is that going to impact differentials and the underlying flows around the world.